Hello, nice to have you here. We start another program today, October 21st at 5 p.m. My name is Mike Patel, and welcome to Home Service Central podcast, which I do every Tuesday. Today, our topic is a very interesting topic, very upcoming topic, and a lot of chatter about this topic on the street today, on the homes today, on the minds of the buyers and sellers. And the topic is, sorry, there was something came up here, so let me turn that off. And let me go live on Instagram as well. There you go. All right, sorry about that. Yeah, so anyway, the topic is foreclosure bloodbath unfolds as mass layoffs hit hard. So hopefully we can discuss that. If you have any comments, let us know what you think about what's happening on the market, in the housing market, in the foreclosure sector. And also, one of the things we're going to talk about is layoffs. Are you seeing any layoffs coming up? So let me know. And I think I'm in live. So let me know in a comment below if you can hear me. Not sure if you can hear me or not, but I'm assuming you can hear me. So let me see here. I'm not sure, but I'm assuming you can all hear me. So here goes. All right, so let's talk about it. First thing I want to mention to you is we're seeing warning signs across America, rising foreclosures, rising layoffs, and homeowners feeling trapped, not only in their homes and making the payments, but increasingly increasing payments, which they are trapped on because they bought a house at a fixed payment, and now the payments are going up because of property taxes and insurance and maintenance costs and upgrades, etc. So tonight we're going to bring down what's really happening and what it means for you as a homeowner, but also if you are a home buyer. Should you buy what you are approved for, or should you buy what you can afford? There's a big difference. So if you're a seller selling your home and buying a bigger house or a smaller home, what are you approved for on what, and what will you be able to afford? Because your property taxes may change from what the property taxes were before. Same thing with the buyer. So you have to be very careful and cautious about what you're going to buy. Let me see here. I'm not sure if you can see me on Instagram or not. I'm going to put that out. Hopefully, you can see me on Instagram as well. I'm on live on Facebook and TikTok and YouTube. Not on TikTok yet, but I'm trying to get there. So anyway, so let's discuss some of these pointers. The best way to tackle this is to share a screen with you. So I'm going to share a screen with you. Let me see here. Share a screen. And I'm going to share with you the first screen. All right. If you can see here, this is from Safeguard Properties. This article came out on October 7th, 2025, just a couple of weeks old. And according to Adam, the source is Adam, the company that does analysis on housing and other stats. Adam, a leading curator of land, property, and real estate data, today released its Q3 2025 U.S. foreclosure market report, which shows that a total of 105,513 U.S. properties with a foreclosure filing during the third quarter of 2025, up less than 1% from the previous quarter and up 17% from a year ago. That's a big number. I'll give you an example. I was showing a house today, and as a realtor, one of the things I do, let me see if you can see my screen here. One of the things I do as a realtor is drive the streets around while I'm waiting for somebody, looking for fixer properties. So I saw a fixer property today. This house, it was locked up. There was a lot of bushes in the front, a lot of dry grass, and it looked really dilapidated. So I took the address down. I came to my office and looked at the title record. And guess what? The house is foreclosed on, and there is an auction coming up next month. So I saw firsthand today an auction property which I have not seen in 3 years. I've been driving around looking for investment properties, fixer-upper homes, because a lot of flippers out there, a lot of investors out there, they want to buy these homes cheap, fix it up and flip it, or rent it out. So I always am on the lookout for such properties. You can just see while you're driving, you can see if the property is dilapidated or needs work. So we kind of knock on the door or approach the seller or write them a letter or call them and try to get the information. So here we go. I saw one today after 3 years, a home that was a fixer-upper, but is already in foreclosure. So it is happening as we speak, and at what level? So according to this report, I'm going to read further. The report shows a total of 35,602 U.S. properties with foreclosure filings in September, down 0.3% from the previous month and up 20% from a year ago. In other words, from a year ago, foreclosure filings have gone up 20%, which indicates one thing: sellers are having a hard time making payments. Otherwise, why would they get behind? Why would a seller who's owned this home, made payments, put a down payment, growing a family there, why would they go behind on payments? Why would they not pay? Not on purpose, because they cannot make the payment. I'm going to read another paragraph to further understand what's going on from this report. In 2025, we've seen a consistent pattern of foreclosures activity trending higher, with both starts and completions posting year-over-year increases for consecutive quarters, said Barber, Rob Barber, CEO at Adam. While these figures remain within a historical reasonable range, the persistence of this trend could be an early indicator of emerging borrower strain in some areas. Foreclosure starts increases nationwide. A total of 72,000 U.S. properties started the foreclosure process in quarter 2025, up 2% from the previous quarters and up 16% from a year ago. So as we can see, there's strain out there. And one of the things we should discuss, what I'm going to discuss is, why is there a strain out there? Well, there's several things, and I'll get to it. Um, but I'm going to give you some more data. U.S. foreclosure filings are up year over year. 72,000 properties started in 2025. National average, 1 in 1,400 homes are in foreclosure filings. 1 in 1,400. That's quite a bit, where we've seen pretty much zero for the last few years. So any filing is a red flag, is a warning signal, and this is persistent. There was foreclosure filings in 2024, but they've increased in 2025. And I can guarantee you that in 2026, these foreclosure filings are going to be higher. Several reasons. One, a lot of the owners who bought 3 years ago, 4 years ago, 5 years ago cannot afford to make the payments, because even if their payments were uh, fixed, now they're not fixed because the property tax went up, insurance went up, maintenance costs went up, upgrades went up. So people are having strain on the increased payments of property tax and insurance. The second thing is, if there was a double income family, wife and husband working, or two brothers working, or two sisters, or mom and dad and kids bought the house together, some of them have lost jobs or are losing jobs. So income has dropped. I'm a realtor, and for the last 25 years, one of the things I do every day, like clockwork, is make calls. I call the buyers or potential buyers, potential sellers, and ask them, "Hey, buyer, do you want to buy a house? You came to my open house." I follow up with them. Or when I meet somebody, a seller, they tell me, "Hey, Mike, I'm thinking about selling." I call them back and say, "Hey, Mr. Seller or Mrs. Seller, you had talked to me 2 months ago about thinking about selling." So what we call and follow up. But things have changed now. As a realtor, I get on average 2 or 3 calls a week from a plumber, from a termite company, from lenders, from contractors, from handyman. Why are they calling me and other realtors? They're calling because they're asking us, "Hey, do you have any job for me? Do you have any termite work to be done?" These are handymen cold calling to realtors and other lenders because they work with buyers and sellers. The tables have turned. They never used to call. We used to call a handyman or a painter or a contractor, and they say, "Well, call me in 2 weeks. Call me in 2 weeks." Now they're calling us to find a job. They don't have any jobs. They're moving. One handyman that I've used for years and years is telling me that his business is very slow. People want to sell homes. They don't want to spend money fixing it up. So the contractors are slow. The handymen are slow. When the home sales are down, termite company, escrow company, a notary company, title company, all the business is slow. So you can see the trend, what's going on with the trend. It is happening. Tables are turning. And I'm trying to find out something here. So I'm going to take a quick look. So let's look at another slide that I'm going to share with you. I'm going to take this slide out and share another slide. Just give me 1 minute. It's from realtor.com. Let me add that here, share. And it shows here, and this is from realtor.com. Let me make sure you can see that. There you go. And this report came out on October 9th, just a couple of weeks ago. It talks about the trends. Foreclosure continues to rise across the US, and there are 10 metros areas that are hit the hardest, which I'll show you in a minute. But I want to read some things about this foreclosure. Foreclosure rates have surged across the country and are up almost 20% from the time of last year. Remember, these are just foreclosure filings. They're not actual foreclosure. So there's a difference. And because there's a lot of equity in the homes, people who bought 2 years ago, 4 years ago, 10 years ago, they built up equity. So they're not going to lose their homes, and I certainly don't hope so. These are not foreclosures for sale. These are foreclosure filings or what do you call appointments to remedy the situation. In 2025, we've seen a consistent pattern of foreclosure activity trending higher, with both starts and completions posting year-over-year increases for consecutive quarters, just like I read earlier. And then I'm going to read the second paragraph. Atom's report incorporates documents filed in all three phases of foreclosure, default, and notice of default, notice of foreclosures, and real estate owned or REO properties. Defines as properties that have been foreclosed on and repurchased by a bank. So some have already been purchased by the bank. And on a side note, guess what's happening on a lot of these foreclosure filings or foreclosure bank foreclosures? Why we don't see it on the street? Why don't we see it as agents, or why don't they show up on the multiple listing service? Because I work with a lot of investors, and they always call me, hey, Mike, keep an eye out for foreclosures or short sales, which are very few or pretty much zero, at least in Southern California. I know certain other states, there are a lot more. But what's happening is, and on a side note, a lot of these foreclosures are being sold to private institutions, private equity firms, and they buy these by the loads. If a bank has 100 foreclosures, these companies buy it out. So it's not even coming to the average buyer or average investor. But that's just a side note I thought I'll mention to you. So if you're a buyer or a seller thinking about buying a foreclosure as a rental, or if you're a buyer thinking of getting a deal on a foreclosure, you may want to wait a little bit, because at this point, they're not a whole lot out there. And even before they hit the market, corporations, institutions, and private equity firms are snatching it from the banks. So you have a slim chance. So let me go further and let's look at the 10 metros with the highest foreclosure rates. Well, I see California and Nevada there. Wow, that's unusual. So the number one is Lakeland in Winter Haven, Florida. Carolina. Three is Cape Coral, Fort Myers, and Florida. Cleveland, Ohio. Ocala, Florida. You can see there's a pattern of Florida. We have almost seven are in Florida. Jacksonville, Florida. And I'm surprised to see number seven, Bakersfield, California. Wow, that's about 2 hours from here. And I'm surprised to see a California name in here. Not that it matters, but Bakersfield has boomed in the last 10 to 15 years. It's a farm town on the way to San Francisco or on the way to San Jose from Los Angeles. And there were so many brand new homes being built there. And they were cheaper homes 4 or 5 years ago. You can buy a home for very lower price than compared to Orange County. So I'm really surprised that Bakersfield is in there. But here you go, Bakersfield is in there. Uh, um, Highest foreclosure rate. So if somebody's looking for deals, that may be a place to go. But there may not be a lot of rentals over there. So I may be cautious about buying. But as you can see, Florida has one, two, three, four, five areas where they have the highest foreclosures, followed by South Carolina and North Carolina. Jacksonville, North Carolina was number 10. Las Vegas, Nevada is also on number 9. And Palm Bay, Melbourne, Titusville in Florida is number 9. So things are happening. These are the stats. It's not just, hey, there's a foreclosure happening. There is foreclosures coming. People are stressed right now. Right now, sellers are having a hard time keeping up with the payments. Sellers are having a hard time buying lunch and dinner. I saw a TikTok video where a seller posted um, a video of himself and his 2-year-old child, and he just got divorced, by the way, so he's keeping the child. And he said, "This is my play area. The play area is his dining room." That was his play area. He was funny about it. And then he was eating noodles, Chinese noodles. He said, "This is our gourmet dinner." How sad that is that he posted that. I'm having a gourmet dinner, which is 99 cents noodles that you buy and put hot water, and that was his gourmet dinner. So there is stress out there. Um, so let's look at furthermore what they say. How does a foreclosure happen? I'm just going to touch on it a little bit. Homeowners have to first default on their mortgage, failing to pay their required monthly payments. And it's rare for lenders to begin foreclosure with just one late mortgage payment. Lenders usually offer alternatives during this period, including different payment plans to help the homeowner stay in their home. The everything for the homeowner to stay in the house. They will try to help you. They'll give you time. They may refinance for a couple of months or a year to lower your payments. Whatever they can to help them. If a borrower can't come up with the funds to pay what they lender will issue a notice of default first. This form will be sent to the mortgagee via a certified letter, and it typically gives homeowners 90 days to pay off the most recent bill. This is the beginning of the formal process. If the homeowner hasn't come up with the money within 90 days of the notice of default, the lender may proceed with the foreclosure. I'm not sure why I'm seeing that. Okay, let me cut that. Sorry, I got distracted here. I was hearing something on my laptop here. So if the homeowner hasn't come up with the money within 90 days of the notice of default, the lender may proceed with the foreclosure. Next comes a notice of sale, which will state that the trustee, the lender, will sell the home at auction within 21 days. The home will be sold at a public auction to the highest bidder, who will have to pay the full amount of the bid immediately. This buyer will receive a trustee's deed once the sale is complete, at which point he becomes the official owner of the home. And if the sellers are still staying in there, the new owner will have to give them a eviction process, which was very common in 2008 when they refused to move out. They didn't want to move out, and legally, the seller cannot just kick them out. They have to serve them with a notice of eviction, etc. So they have to go to a legal channel to come up with it. So while I have a moment, I wanted to let you know that if you have any questions, let us know, or let us know in the comments what's happening in your neighborhood. Are you seeing stress in the neighborhoods? Are you seeing any foreclosures? Are the home prices stabilizing? Are they going up or down? Half the US prices are going up, and half of US prices are coming down. So a lot of the northeastern states prices are up. A lot of the Sun Belt states and areas, the prices are down. California is generally up, but like we saw, Bakersfield is a pocket where there's a lot of foreclosures. In fact, it's on the top of foreclosures. So we are seeing some things that's coming out of the woodworks. We are seeing foreclosures. We are seeing stress, not only on the buyers. Buyers are saying on one hand that, hey, I cannot afford to buy the house because the property taxes have gone up. Insurance has gone up when they buy the property because the home prices are higher. Interest rates are higher. My payment has not increased, but everything else has gone up. So buyers are stressed as well. Buyers are stressed on one hand, but at the same time, sellers are stressed because some of them cannot sell. In certain areas, it's taking 3 or 4 months to sell a house. In a lot of areas, in fact, in 2025 so far, about 40% of all the homes that have sold have either reduced their prices or they've given some form of concession. Just 2 years ago, if you made an offer and asked the seller, hey, would you give me a $5,000 credit on repairing, or would you fix this, or would you help me with the down payment or the closing cost, they would kick you in the butt. Well, not literally, but they would kick you in the butt and say, take a hike. Now, 40 to 50%, actually 40% of all the sellers have already given concessions to the buyer. What does that tell you? Market has slowed down. The other thing is the inventory has gone up. It used to be 30 days, 40 days inventory. Now it's gone up to 3 or 4 or 5 months, depending on what state you are on. And it's taking longer to sell a house. It's taking 2 to 3 to 4 months to sell a house. In certain areas, like in Southern California, where I'm at in Orange County, it's taking up to 45 days to sell a house. So the time to sell a house has gone up. The amount has gone down. But the confusing thing is home prices are not dropping overall. Like I said, 50% of the homes have increases and 50% of the homes have decreases in value. So it's very difficult to understand. Okay, so JF Enterprise, 15 minutes in. I'm not sure what you're trying to say. Only 4 of us. Well, there's a lot more watching JF Enterprise, because some of them are watching on Twitter, some of them are watching on Facebook, some of them are watching on Instagram, and some of them are watching on YouTube. So share this channel if you like, and we can bring more people in. But in the meantime, if you have any questions or comments, please let me know. I'll be glad to answer any questions. And I'm trying to grow my channel. So if you would like to subscribe, that'll be great. And share this channel. I would really appreciate it. But my objective for this channel is not to have a lot of viewers and a lot of subscribers, but my objective is to give you the information. Hopefully you can use that information either today or 2 or 3 months down the road, or maybe a year later when you want to sell your home. So I'm here to help you, give you information, share the information that I have. So let's see. Okay, we have JF Enterprise. Hey, nice to see you, JF Enterprise. I know that's not your name, but I know you watch a lot of my videos and my channel. So I appreciate you watching it. And let me know if you have any specific questions. I'll be glad to help you. So let's move on to the next topic that I have, which is, let's talk about the job loss. I've talked about job losses, or maybe not. Job losses are triggering mortgage stress. So I'm going to bring out another slide here. Let me see. Okay, I'm going to share another screen here quickly. Let me hold on. Stop screen, and I'm going to share another screen. Sorry about that. Okay, so let's talk about this. This is an article from Inc. Came out on September 18th, 2025, and it talks about the layoffs. So let me read an article just briefly. What happens when laid off tech employees can't pay their mortgages? Did they say the tech industry? Yes, tech industry is in a turmoil. Google, Microsoft, Apple, you name it. A lot of them are laying off people, 10,000, 3,000, 15,000. They have already announced these in the next year or so. Some of them are local, some of them are international, yet there's a lot of layoffs in the tech industry. At the same time, a lot of the companies are hiring. Companies like the NVIDIA company and the OpenAI, which handles with the artificial intelligence, those kind of companies are hiring. So the question is, do you feel the AI is stealing jobs? Who knows? We don't know yet, but a lot of people are saying that a lot of the AI tools that we have, a lot of AI software, robots, things that are coming out in the next year, the next 2 or 3 years, are going to be robbing a lot of jobs. So we need to be prepared. The tech industry, according to this report, is laying off its own customer base. Meanwhile, searches for help with mortgage are nearing 2008 levels. Wow, that is surprising. Let me read further. The statement was etched into my brain over 10 years ago, and I've never forgotten. It was having an after-work beer with Derek, a fellow tech startup founder and friend of mine. At this point in time, mid-2014, we were both worried about the exit window collapsing on our companies. They're talking about the tech companies. Fast forward a year later, and he and I went into 2 similar but different directions. My company got acquired by a private equity firm, and we entered our next exciting phase. His startup got acquired in what's known as an acqui-hire, where an acquirer, in this case a mid-sized tech company, sweeps in and buys a smaller company's talent and the customer base. Everyone gets paid and most people keep their jobs. No one gets rich. At least that's how it used to work. Founder bias has kind of messed up in the AI age. Now apparently the founders get rich and everyone else loses their jobs. So this is a reality. I'm not just saying to make a channel or get a lot of views on my channel like a lot of other bloggers and vloggers do. I'm here to tell you that things are happening. The real estate market is stressing, but the very confusing thing is home prices overall are still going to go up. They're not just dropping. There was a slide here. I'm not sure what happened to that slide. Let me share you a slide while I'm talking about home prices. I'm going to share a slide again. Stop the screen, and I'm going to share another slide here. Since I talked about the home prices, this is from from a blog that I read and a company that I follow. It's called Keeping Current Matters. Is the housing market going to crash? Here's what experts are saying. So it's not what I'm saying or what others are saying, but these are what experts are saying. These are big tech companies, real estate tech companies, analysis companies, real estate experts, real estate data company who follow and track the data of homes being sold. How much are they being sold for? Are there price increases, price decreases, etc.? It says here that if you've seen headlines or social posts calling for a housing crash, it's easy to wonder if home values are about to take a hit. But here's the simple truth. The data doesn't point to a crash. It points to a slow, continued growth. So it's very confusing. Some of the articles, big articles, say that, hey, there's a lot of foreclosures, home prices are going to crash, home prices are going to come down, there are layoffs. There's other companies are saying that, wait, hold your horses, there is no crash, there is no price drop. So it's very confusing, and that's where your local area comes in. Real estate is local. Local trends, the national trends may not match local trends. For example, Southern California home prices are still going up. I just sold 3 homes on a lot. It was listed for 1.95. We wrote an offer and we got a counter back. This is for a $1.95 million property, 3 on a lot. That means there are 3 homes on a lot, and they had multiple offers. So I got to my surprise, we were all cash, and I thought we were going to get it. We got a good offer. We got a 30-day close. But I was shocked when I received a counter offer from the seller saying, submit your highest and best offer. All contingencies to be removed in 12 days, escrow to close in 30 days, a deposit to be deposited into the bank within 3 days, blah, blah, blah. Very strict counter offer. And I was shocked to get it. Fortunately, my buyers did get the offer accepted, so we got the offer. So what I'm saying is in certain areas, there are multiple offers and homes are selling over list price, where in certain other states like Arizona, Texas, North Carolina, South Carolina, Tennessee, Florida, home prices have really dropped and homes prices are decreasing. As I mentioned earlier, half the country prices are going up and half the country prices are going down. So real estate is local, as they all say. So let me go back to this slide here. The data doesn't point to a crash. It points to a slow, continued growth. And sure, it's going to vary by local areas. Some markets will see prices rise more than others, and some may even see small short-term declines. But the big picture is home prices are expected to rise nationally, not fall, over the next 5 years. Wait, did I say that right? Did I read that right? Let me read that again. Home prices are expected to rise nationally, not fall, over the next 5 years. Wow. And that's not me saying, this is this report saying. And let's look further into this report, because this is something new to me. Also, in the home price expectation survey from Fannie Mae, each quarter over 100 leading housing market experts weigh in on where they project home prices will go from here. By the way, on a side note, there is no such thing as an expert, because nobody seems to predict anything. So I don't know where these experts come from or what they do, but they've never predicted anything. They never predicted the 2008 market. They never predicted what's going to happen in the COVID market. They never predicted anything about the 1 or 2%. They never predicted the tariffs implication on the housing market. And here they are predicting. So just a side note. And I've had a lot of coffee today. So just to give you some heads up on there. And in the report that was just released, the experts agree prices are projected to climb nationally through at least 2029. So let's look at the graph. Forecasts show prices will rise through 2029. In 2025, they're going up to 2.42%. And that's pretty correct because home prices have gone up. Overall, some places are down, some places are significantly higher, but on average, it has gone up to 2.42. Whoops, what happened here? Let me go back. Oh, sorry about that. Let me go back here. Let me see if we can read that. Yep, there it is. Okay, so coming back to the report, 2026, the home prices are going to go up 2.8% from 2025, which means it's going to be up 4% from 2024, if you read it that way. In 2027, it's going to go up another 3% from 2026. And in 2028, 3.48%. And in 2029, it's going to be up almost 3.5%. I don't know why I keep doing this. Let me see here. Sorry about this. Let me go back. I don't know what's going on here. Okay, there you go. So let me know what you think. Do you think home prices are going to go up through 2028 or 2029, let alone 2026? In your neighborhood, do you expect it to go up or do you expect it to go down? I'd like to find out what's happening in certain areas. So if you want to comment, I'd appreciate it. And we'll go from there. Now going back to layoffs and comparing it to the price increases and the strain on homeowners having a strain on payments. It says here, this is from another report, and I kind of wrote it down so I can discuss it to the point here. It says that the tech and white collar layoffs are now a major source of defaults. Tech and white collar layoffs, okay, are a major source of defaults. Intel laid off 24,000, Microsoft 15,000, Amazon is laying off 14,000, Meta 3,600 job cuts. Of course, the good news is this is worldwide. It's not just USA, and it's in increments. It's not one time, so it's in increments and it's worldwide. So the numbers could be lower for USA. Homeowners with $150,000 plus income are seeing delinquencies rise 42% year over year. So what they're saying is, even with people making a lot of money, $150,000 plus, 200,000, 300,000, a lot of these are tech people, corporate people, executives of businesses. They're seeing strains and they're behind, and 42% are seeing strains from a year over year ago. Not that they're behind, but they're seeing strains in payments. Loss of stock-based pay reduces refinancing options and equity cushions. Connection to so what they're saying is some of them are not getting the bonuses as everything goes down. Like I'm in real estate, and of course, real estate has been very challenging. So in general, real estate income is down also for realtors. I'll give you an example as a comparison. In 2023, over 6 million homes sold. That means 6 million homes sold. That means there were 12 million transactions, right? There's a buyer's agent and a seller's agent, assuming each has two sides. So there were 12 million transactions. In 2025, there's going to be just under 4.5 million home sales. That means there's going to be 9 million transactions, which means we are 3 million transactions lower. That means 3 million less realtors made less money. 3 million are not there. But think about it. All the escrow companies, the title companies, the moving companies, the notary companies, the handyman, the termite company, the cleaning ladies, the staging companies, all their transactions were down because when transactions from 12 million goes down to 9 million transactions, that's a 3 million transactions. And on average, when a home sale, it employs about 200 people. So if you take 3 million, multiply that by 200 jobs, quote, do the math. A lot of people are making less money, including myself, compared to 2023. My income is down as well. And overall, realtors' income is down, lenders' income is down, escrow company income is down, and the average worker's income is down on average. And some of them are even losing their jobs. Some of them are losing their bonuses. Some of them are losing their commissions, etc. So there is stress out there. So let's look at, I'm going to take this out and share another screen, and I'm going to talk about what happens when they cannot make payments. So let's look at that. So that one is, let's see, which, make them okay. So let me share this one here. Just give me 1 minute. Sorry. Share screen, and it's the QZ. Okay, here's another one. It talks about layoffs. Layoffs, and this is from an article by Quartz. Layoffs are surging as 2025 becomes the year of the pink slip. US job cuts have risen almost 50% year over year. Wow, let me read that again. US job cuts have risen almost 50% year over year. Hiring is down, with some sectors hit even harder. Services, retail, tech, and nonprofit leads the cuts. US employers announced almost 100,000 job cuts in May, up an eye-watering 47% from the same month last year, according to new data released Thursday morning by the outplacement firm Challenges, Gray, and Christmas. Even with a slight decline from April, the 47% year-over-year jump makes it clear layoffs are a rapidly accelerating trend. What was a murmur is becoming a scream. So I want to find out what's your thought on that. Right now, there's a federal shutdown. I don't watch the news anymore and not keeping track of the shutdown, but there's a big impact of the federal shutdown. What's happening is a lot of the first-time home buyers, I'll give you an example. A lot of the first-time home buyers get a loan from the government program, which is the FHA, Federal Housing Authority. And a lot of the VAs get loans from VA. Now that the government has shut down, guess what? All those loans and processing of escrow will be delayed, or a lot of the escrows will cancel, because if I'm a seller and I sold my house to a VA and the government is shut down, how long am I going to wait? I may change my plans and not sell. So we're going to see a lot of escrow cancellations. We're going to see a lot of deals fall through. We're going to see a lot of a fight between the buyers and the sellers, where buyers are going to say, well, look, the government shut down. I could not get the loan. Give me more time. And the sellers saying, I'm impatient. I need to get to Phoenix to my dad, or to my relocation, or to get a bigger house, or whatever. And they may not sell and rent it out and then buy another house. So let's see what happens to the housing market of the shutdown. But one thing is for sure, there will be a significant impact on a lot of closures or cancellation of escrows and a lot of delays. So I'm just waiting to see what kind of delays we have and what kind of implication it brings out. In all, 2025 looks to be on track to scorch recent records. Boy, that's strong language. Just 6 months into 2025, employers have already announced almost 700,000 job cuts. That's a whopping 80% increase from the same period last year, and just 65,000 short of all layoff tracked in 2024. I'm going to read one more paragraph. Service, retail, nonprofit, and tech lead in layoffs. The service sector, sorry about that, which includes temporary staffing, cleaning services, and other business-to-business support providers, led the way in May with more than 22,000 layoffs, the worst month for a category since May 2020. Retailers followed with 11,483 job cut announcements, bringing the year-to-date total to more than 75,000. That's up 274% from the same point in 2024. So we are seeing the impact of job cuts happening. A lot of the high income earners, the average or the median household income in US is about $85,000, and they cannot afford a $400,000 house, which is the medium home price today, because to buy a $427,000 house, which is the medium home price today, and the medium home income is $85,000, there's a mismatch. So for an average homeowner to buy a medium home price home of $427,000, the household income needs to make $127,000. Because the prices went up so rapidly, we see a big gap between the income and the ability or the affordability to buy the medium price home. And that's where the strain is coming. A lot of the buyers bought, pushed and shoved to get qualified. Now that the property tax went up, insurance went up, utility bills went up, medical bills went up, everything went up, they're having a hard time making payments, because now their $3,000 or $4,000 a month payment has reached $5,000 and they can't keep up with it. And the income has stayed stable, or it has actually dropped, or they lost a job. So this is reality. I hate to be negative and bringing these things out, but this is what's happening right now. I'm going to read another report. Let me see here. So let me know if you know somebody who's been laid off, or if in your area are there any layoffs going on, or what's happening. So let's find out. I'm going to stop the screen here, and then let me touch on why there's strain, why the sellers who bought the house, put the down payment, got approved, got qualified, and bought the house and stayed in the house for 1 year, 2 year, 3 year, 4 years, was able to afford to make the payments and make a living, now having a hard time. So let's look at that. The key factor, two main factors, and obviously you probably already know this, but the two factors is the insurance and the property tax. Insurance premiums are up 25% per year in some states, including Florida. I have insurance with State Farm, and this year, or I think starting 2026, the insurance commissioner just approved an increase of 22% of all the premiums with State Farm insurance, because any increase by these insurance companies has to be approved by the state commissioner or state or whatever, which just got approved. So my insurance is State Farm, my car insurance, my home insurance, my business insurance. And guess what? My insurance premium is going to go up 22%. So if I was paying $1,000 a month or $1,000 a year, it's going to be $1,222 this year. So that's going to put a strain on me. Quote, not to mention my water bill doubled. My electricity has doubled from 2 years ago. My gas bill, summertime, I didn't have any because I don't use the heater, and I have an electric water, so I don't use a lot of gas, but everything has gone up. Oh, by the way, my medical insurance has skyrocketed. So, and when I say me, I'm saying it because anybody's insurance, medical insurance has gone up. If it's gone up for me, it's gone up for a lot of people. Medical insurance, electricity, utilities, groceries, diapers, college, if you have kids, backpacks, books, pencils, everything has gone up. Lunch costs $20 today, an average lunch that used to cost $10. You go to Carl's Jr., and a special is now $17. Used to be specials, used to be $5.99, $8.99. Now you get a drink, fries, and a burger. It's $16, and they call it a special. That used to be my lunch, and now it's a special. Wow. So tough times are here. And that's why there's a strain. Property taxes are up 30 to 50% since 2019 in multiple counties. A lot of states. Luckily, I'm in California. And in California, our property taxes are fixed because of Prop 13. The Howard Jarvis Association put a cap on property tax increase. So at least in Orange County in Southern California, our taxes are around 1.1 to 1.2%, depending on what county you're in. But I know in certain counties, like in Texas, certain counties in Nebraska, Montana, Florida, Arizona, property taxes in some counties and cities and areas have doubled, quadrupled, and tripled, have gone up sky high. And that's why a lot of the strain in mortgage payments are coming. So the PITI, which is the principal, interest, tax, and insurance, even though it's a fixed amount, Your PI is fixed, your principal and interest, but your taxes and your insurance is never fixed, and it has skyrocketed, which has never happened in the last 20 years. But in the last 2-3 years, that has been happening. It's still happening, and it's not going to stop. And that's putting a lot of strain on the homeowners, including those who make 150, 200, 250,000. In Southern California, the median home price is about $1 million. In Anaheim Hills, it's 1.2. So if you put a 20% down payment, your mortgage payment is going to be $6,000 or $7,000, just like that. And then if it goes up by $1,000 and you barely qualify to make the $7,000 payment and it goes up to $9,000, you're in trouble. Not mentioning your property, your medical insurance going up, medical payments going up, your utilities going up. So that $7,000 all of a sudden becomes $10,000, and that's why there's a strain. So let's talk about the maintenance of the home. Anybody who buys a home has to have to do maintenance. I just had my garbage disposal fixed, called a plumber. It was $300. He was in and out in half an hour, $300. So the cost of everything has gone up because of the tariffs and the inflation and just the way the economy is, but also the labor cost has gone up. $100 is just a service call. If you call a plumber or if you call somebody, they charge you $100 just for coming. Then they charge you for the hour and a half that they stay there. Then they charge you for the parts. So everything is expensive. Utilities have gone up. I won't talk about it. I've already talked about it. It has gone up sky high nationwide. But let's talk about the Homeowners Association. A lot of states, specifically Florida, Homeowners Association skyrocketed because of insurances. So what the homeowners who have HOA has a double whammy. Their insurance goes up sky high because, the HOA goes sky high because the insurance goes up, and the HOA, the master policy, goes up. So the property management company or the homeowners association charges each homeowner for the increase. So one, they have an increase in property taxes, they have an increase in insurance. They still have to buy insurance even though they may have a master policy. Then the HOA goes up. So PITI plus HOA plus maintenance plus utilities, all that goes up, and your $5,000 payment becomes a $7,000, and that's a problem. So like they say, Houston, we have a problem. Now, the key thing to remember or to look at is homeowners with a 3% mortgage still face payment jumps of 30 to 40% due to escrow hikes. And the escrow hikes are the property taxes and insurance because they put a lower down payment. Nationwide, median home price is about $423,000, requires a $94,000 income, which is $15,000 higher than the median household income, which I talked about it earlier. So what's happening is when these home buyers buy the properties, they use up their life savings. They do everything to be able to qualify. They move in, they fix up things, and now everything goes up, and they're into a pickle. And more people are getting into a pickle. So that's what's happening. One of the reasons that I want to touch on, one of the things is the corporate and institutional takeover of housing. This is having an impact on home prices in a lot of areas. One of the areas is Atlanta. And I'll tell you how home prices are not dropping because of institutional buyers, because of Wall Street, because of Blackstone, because of private equity firms buying homes in droves. Earlier, I mentioned that a lot of these foreclosures are being bought by these private equity firms and big corporate people because banks would rather sell to one buyer than have 100 buyers. But also what's happening is these big corporations have a lot of money, 100 million, 20 million, 40 million. They go into an area, buy a lot of homes, go to new home builders and buy the whole lot of homes. In fact, it happened to one of the communities where they bought a lot of these homes, they buy out. If there's 400 homes, they buy them all out. Then what they do is they rent them out, increase the rent, which increases the value of their home. So when the value of the home increase, they sell that house. So if they bought the house for $300,000, now they sell it for $450,000 after a year or 2 years. That just increases the home, the comparatives. So now they sell all the others. So they bought the house for $300,000, manipulated the rents and the comps. They're selling it to the local people on higher prices, and they're fighting it and they're crying about the higher prices. So what's happening is the private equity and the REITs, which is the real estate investment trust, are buying distressed homes at 60 to 70% on the dollar, and they're buying a whole bunch of them. 61% of bulk transactions they paid in cash. Roughly 1 in 5 sales in parts of Texas, Georgia, Florida go to institutional investors. Homeowners rate has dropped below 62% and the lowest in 50 years because a lot of the homes are being sold to institutions. So used to be home ownership used to be about 2 or 3 years ago about 64%, but it's dropped to 62%. And I see it coming in at 50% in the next 10 years. And one of the reasons I'm saying that is because the new dream is not to buy a house, is to own a house. And furthermore, what's happening with this institutional um, firms and equity firms, they're buying homes, they're building homes, they're building 500 homes, 1,000 homes, 1,000 townhouses, and they keep it and they rent it out. And that's how they make money. So one, they build their own properties, which is cheaper. So a house that you buy for 400 may just cost them $250,000 because they're buying so many, they're building so many in bulk. So one, it costs them less. Then once they build it, they rent it out, and they have no mortgage. Remember, these are private equity companies, so they have no mortgage because they pay cash. So now they have 1,000 homes and apartment units and townhouses, all income coming in, millions and millions of dollars a month, and they're making money and buying other properties while the homeowners who wanted to buy cannot buy. They ends up listing. I have a comment from JF. Mitch Wexler, let me put it on. Mentioned yesterday some entity bought a whole bunch of unfurnished homes for around 20 cents on the dollar from a home builder. Forget where it is. Yes, this is happening. And you just saw from one of my viewers, it is happening. This is reality. So I see home ownership dropping if this trend continues. So this is not very good news. And I hate to be the bearer of bad news. But if you're a homeowner, you need to buckle up and plan for your future about not losing your home and becoming one of the renters to these private institutions and other homeowners. By the way, not only are these institutions buying a lot of homes as investments, but I work with a lot of investors. They have money. They bought property 20 years ago. Now the value has gone up. So they're pulling equity out of these rentals and then buying other homes. So the rich people who have 2 or 3 homes are now going to have 4 or 5 or 6 homes. So more and more owners have multiple owners, and more and more institutions are buying more, which means less and less homeowners are out there, which means more and more people are renting. So home ownership is in the decline. The new dream is not to be a homeowner, and this is from a report. The new dream is A, pay off your debt, and B, become a renter. Can you believe that? This is 2025, and the new dream is just renting. But on the other hand, a lot of the Gen Zs and millennials don't want to buy a house. They want to rent. They want their freedom. So it's good and bad depending on your attitude, your financial, and your future plans. So yes, renting could be good. A lot of the Gen Zs and millennials want it that way. But a lot of the older folks, a lot of the boomers, we want our own houses because we don't want to pay rent when we are 75 years old, 80 years old, and the rent may be $5,000 for the house that I'm paying $3,000 right now. So let's see what happens. And then, so when less and less people own more and more homes, this accelerates wealth concentration and turns housing into a corporate asset rather than a family foundation. So I read a report that these days housing is being traded like stocks. You know, you buy stocks and you can flip it or sell it the next day. Same thing's happening with homes. A lot of these institutions buy these homes. Like this gentleman just said, they bought 20 cents on the dollar. Guess what they'll do? They'll fix it up and they'll sell it for $1 to $1. So if they bought a house for $250,000, which was worth $700,000, even if they sell for $500,000, they made $250,000 on that house. So the rich are getting richer. No, let me take that back. the rich are becoming filthy richer, and the poor are getting really poorer. And one of the biggest way to become wealthy is owning real estate. The net worth of a homeowner is 42 times more than a renter. So if there's more and more renters coming up, aren't renters becoming poorer and poorer, or the net worth is becoming lower and lower? And those who are buying now multiple properties, and they becoming richer and richer? So I would say that in 5 years, the net worth of a homeowner will be worth 80% more than a renter. That's where we're headed. So in one hand, people want to own a house because it's a security, it's an asset. After 20, 30 years, when you pay off the home, you don't have any payments. But at the same time, they're having a hard time making those payments. So it's becoming difficult. So why does this matter? And why is it that in some areas home prices are going up and in some areas home prices are going down? Let's look at that. One of the factors is the inventory. Like in Southern California, inventory has not gone up as much as it has gone up in Arizona, Florida, Tennessee, Texas, Nevada. All those areas, inventory has jumped 30, 40, 50%. In California, where I'm at, it hasn't gone up that much. So the more inventory you have, for example, when I showed you that chart of the 10 metro areas where there's a lot of foreclosures, 6 of them were in Florida. So because there's a lot of inventory, of course, a lot of people cannot sell their homes and the prices go down. So let me go back to 2008. In 2008, during the recession, a lot of homes would sit on the market for a year. The inventory, they had 12 months supply of inventory of homes for sale. Right now, we're at about 3 or 4 months. So the inventory is still low on average. So the home prices are holding on and the buyers cannot afford it because the prices are not dropping or they're not crashing. Rents are rising as corporate convert foreclosures into rentals. That makes it difficult for people to even rent, because when an investor buys a property and if they pay a higher price and they have higher property taxes and they have higher insurance, higher gardening cost, then they're going to direct that expenses towards the renter. So the renter, number one, cannot afford to buy a house, but at the same time is having a hard time making rental payments or finding rental properties. So there is a lot of diversity in the local community as far as renters and homeowners, and it's growing. More and more homeowners own more and more homes, and a lot of the renters will be keep renting at a high cost. In fact, in Los Angeles County, the paycheck that they get, almost 40 to 50% of their paychecks is going towards their home payments, whether it's mortgage payments or rental payments or household expenses. So it is very tough in certain areas where a household pays 50% towards household income. So after they pay their property taxes and your income taxes, how much do they have left for food and clothing and entertainment? Not a whole lot. So there is a lot of stress out there. So the question is, I want to get your opinion. Should big investors be limited in how many homes they can buy? What do you think? Let me know. Whether you're watching live, make a comment, or if you're watching it afterwards as a recording, make a comment, let me know. And if you have any questions, I'll be glad to answer any questions. So I want to wrap up with a couple of things. One is foreclosures are climbing. Of course, in certain areas, there's a jump, but in certain areas, there is no foreclosures. But overall, foreclosures have gone up and will be going up as more distress is out there. Layoffs are adding more pressure. So as there are more layoffs, there'll be more stress and more late payments on mortgages. And as payments get late, there'll be more foreclosure filings. The costs are still skyrocketing. Home affordability is still very high. It has been the highest in the last 35 years, and I don't see it dropping. According to reports, it's still going to keep going up. Institutional investors are reshaping ownership. They're not going away, and more institutions are going to buy. And I've heard of one private equity fund. All they do, they have millions and millions and millions of dollars. All they're going to do is buy land, 5 acres, 10 acres, metro areas, suburban areas, downtown areas, tear up buildings, build brand new homes, brand new townhomes, but they're not going to sell, they're going to rent. So keep an eye out there, because that's coming in a big way. So as I mentioned earlier, the market is local. Maybe the national news is not good, or the national news is good, but it may be the opposite for you, because real estate is local. What's happening in California may not be happening in Florida. What's happening in Texas may not be happening in Montana. It's very different. We have a comment from Jeff again. He's saying that someone mentioned a different tax rate. Let me bring it up and read it so I can read it here. He's saying that someone mentioned a different tax rate for a primary residence versus as a business entity, similar to how bank charges you more interest on a secondary home versus a primary home. Well, as far as the property taxes goes, from what I understand, at least in Southern California, the property taxes are same for everybody, because it's based on your purchase price, whether you are a corporation, whether you're an individual, or whether you're a trust, or whether you're a private equity fund. So that might be true in certain states. I'm not aware of it. But if I had to guess, I don't think that's true. But like I said, at least that's not true in my house and in Southern California. But that's something new. And I hope that they do that. But again, the private institutions have control over politicians. I'm not saying anything wrong here. They have control over politicians, and they could pass that bill and they could get away with it. After all, the wealthy control what's happening. The wealthy can corrupt politicians. Most corrupt politicians are corrupt, according to what I've seen, and they'll do it all day long. And if these big boys can convince the local politicians to make that property tax less for institutions, that may happen. Who knows? But a good point, and that's could be a reality. So if you're thinking of selling or just want to understand your home's equity position, message me directly. Let's stay informed, stay proactive, and stay wise. I have a network of realtors all over the USA, and they can give you exactly what's happening in your local neighborhood. See you next Tuesday at 5 p.m. Thanks for watching. I'm Mike Patel.